What's going on, guys? We're going to be going over an option strategy on GameStop stock. And as we can see, GameStop has been pretty volatile the past week, but that just means it's great for option sellers to make some nice money on some options premium. Now, why do we want to make money off of selling premium? It's just because these contracts they can increase and decrease in value drastically. So let's head over to Wall Street Bets and check out an example. This guy turned he basically became a millionaire in just a few days and absolutely lost it just because of the price movement of GameStop. See, we can see the past month, March 14th, it rose from $78 per share to $190 per share, and that's exactly this day here when he rose to almost become a millionaire. He's just slightly above the $900,000 mark. Crazy, crazy gains. But of course, he held the contracts for too long. As you can see, the past week it is down 13%. The contracts, probably call options, got absolutely crushed. And then the premiums decayed drastically. So he lost a ton of money on that just by holding a little bit too long. So when you're trading options, you really want to do some proper risk management and take profits when you can see it. Um, and you don't always have to take the entire profit. If you have like 10 contracts, you could always just sell maybe 5 contracts or 4 contracts. Just trim your position along the way as you see fit, just to lock in those gains and make sure you don't lose them. So let's go over an option strategy of GameStop. In GameStop, they're pretty volatile right now just because they announced a stock split, which means that the stock is going to be a lot cheaper than it is. But overall, the market cap is going to be the same. And if you have like a few shares of GameStop, it's going to turn into multiple shares just to account for the cheaper stock price. Now, why does this matter? This matters because right now, at $150 per share, it's a little bit unreasonable for people with smaller accounts to sell options just because you need $15,000 of collateral to sell call options or put options. Because you do need to have enough collateral to cover 100 shares of the stock. So if we have, so this is for an example, we can do an April 29th expiration date. Now, of course, this is pre-stock split. So these contracts are going to be a little bit cheaper than when it is when the stock does split. But right now, we just want to showcase how high the implied volatility is. It's around 109%. And we can go pretty far out of the money, as we can see here. For an example, if you have $12,000 of collateral in your account, and as we can see here, we actually do have this, but I'm not going to be selling this option. This is just a trade example of what you can do. So you want to pick and choose stocks that you like, um, and you can utilize the strategy on those stocks. This is just an example of an option strategy. So we can see here, $120 strike. Chance of profit is slightly over 80%, so pretty high chance of profit, and we're receiving $385 of premium, which is pretty sweet, honestly, with an April 29th expiration date. Because we are collecting $385 of premium, our new break even point is going to be the strike price subtracted by the premium, which is going to give us a break even point of $116.15 per share. So as long as GameStop stays above this break even point, we're going to be making money, which is pretty sweet. So it gives us a really nice buffer. And as we can see here on this expected profit and loss, yeah, our max profit is going to be the premium we're collecting. So that's the only downside of selling a put option. Our max profit is capped. And we do, of course, have to disclose that we have unlimited, basically unlimited max loss, which is because if the stock goes to zero, you're going to be losing about $12,000 roughly. But of course, we don't think that that's going to happen. You really want to do the strategy on stocks that you think are going to maintain its value. But if you do want unlimited upside potential, because we're collecting $385 of premium, we can go ahead and use some of that premium to buy a call option for cheaper. So you could do something like say a two. I don't know. This call options are really expensive right now. And as we can see, a lot of people are pouring money into call options because people are very bullish on it. And remember, selling put options is also bullish. It's a bullish neutral position. So we do want the stock to rise if it can. But what we can do is we can use some of our premium to buy some call options. So for example, we can buy a 270 strike call option. Now that's pretty far out of the money. But it does give us, as we can see here, unlimited profit potential, and we're collecting $125 of credit. So we always want to collect a credit on this strategy. We're buying a put option and a call option for a bit cheaper. And of course, our max loss is going to be the same since we will become a shareholder if we do get assigned shares. But with the strategy, we can therefore have unlimited max profit potential, which is pretty sweet. So utilize what strategy you want. If you think GameStop is going to squeeze, you could of course use this strategy. But of course, if you think it's going to remain somewhat flat, you could just sell a simple put option. So that's about it for this video. Thanks for watching.